Rahul Chadha joins us now. Rahul, we are welcoming you on the show with the ring of an all-time high on the markets. What a year it's been. What a year it's been. The naysayers are saying this is liquidity which is driving markets. The bulls are saying, look, this is markets which are telling you that the future will be much brighter than what the past was. What is the right way of looking at this market? And the gains which we've seen in last couple of months, are they here to stay?
Yeah. Nico, we've discussed a number of times over the last 6 months, and you would have realized we've been constructive on markets. The rest of the stories were basically lockdowns because of second, third stage of coronavirus breaking out across economies. If we look at Europe, what we've seen is lockdowns being very reasonable. They're not as stringent as the ones which were seen in April. So the economic momentum is strong. Even in India, why this rally happened, in particular financials, it was basically better than expected numbers, strong economic data. That's what's happened. We've often said this, and we believe that looking at an index is not really the right thing, because what happens in India particularly is we have got different components of index which has its own unique drivers. So we had June, July where Reliance took this market up, IT did well, so took the market up. But the domestic economy for financials, industrials has lagged, and with the recovery coming back there, I think that's what's going to lead the markets up from here. So we'd remain constructive on markets. Yeah.
Okay. So let's look at the factors which currently are at play. Rahul, markets are no longer nervous about the economy, if at all. 8 out of 10 or 7 out of 10 market men believe that the gains, the growth is back. Earnings are finally above expectations, and margin expansion is here to stay. So how much of your bullish belief or bullish scenario is in the price right now? When we spoke about your constructive view on the market, markets were nervous, your view was constructive. Now markets are at an all-time high and your view is also constructive. So are markets pricing in a constructive scenario already?
Okay, so just let's rewind and go back 3-4 years. Markets tried being bullish, and obviously they were positioned for a recovery, but that recovery didn't really happen because first we had demon and then we had GST. And when economy was recovering from early this year, late last year, we had the coronavirus breakout. So again, if you see markets or economies tried to recover a couple of times last 4-5 years, but we've not seen the full follow through of that recovery coming through. The underlying still is very positive, and why I say that the underlying is positive is that unlike 2007, 2008, we don't have those excesses in the economy. There is no excess inventory buildup. There's no excess capital expenditure being done. The housing market's been in doldrums for the last 20 years. So those excesses are not there. And if we see this year also, the government's been focused more on economy. We've not seen any of those things which we saw last year, the citizenship bill and all these things which distract the government from the economic things. The forex reserves are up 30-40% in last 1 year. So all this is a backdrop for a strong economic recovery. To answer your question specifically, I think a lot of the gains are priced in consumer staples, probably somewhat in discretionary, particularly autos. That's why from here on, what would happen is economic cyclicals like the banks, which are still 20% below their Feb lows, real estate, industrials will take the market up. So here, what takes the market up is investment cycles. So these names, if we are right on a view on economic recovery, on the investment cycle coming back because of all these PLI schemes, etc., businesses looking to reinvest are going to be significantly higher over the next 12 to 18 months, whereas something like a IT would compound in line with the earnings growth. So IT would be 10-15% return sector, whereas financials or industrials will make you significant gains over 12 to 18 months.
Okay, that's giving us a nice overview, Rahul. If we actually get into some of those themes specifically, let's say, I mean, when you talked about IT, for example, or even if we throw in pharma into that basket, given the kind of gains that we've already seen, even if you're looking at a 12 to 18 month time frame, what would be the strategy? Would you continue to just hold the leaders of the pack? Would you be looking deeper into the sector? Are you looking at actually seeing perhaps even expanded returns if the prospects are so strong?
See, we continue to hold IT pharma again in our portfolios. The reason for this is also they're a good hedge against a geopolitical risk. 3 months back, we were talking about all these things on the border. Now all's gone quiet. So obviously, everybody, including us, is focused on the domestic cyclicals. But look, there are all these kind of moving parts which are there, and all these issues can come up anytime. So which is where one wants to hedge the portfolios, and portfolios are well hedged through IT pharma. Earnings growth is going to be 10 to 15% here. Again, pharma, we are a lot more selective. IT, I think you will be seeing a lot more broad-based growth, and that growth picks up next year, basically, as most companies do this digital spends. So again, IT pharma, I would say, is a low return sector, 10 to 15%. And if you're right on recovery coming through, basically, again, that's where financials will give you strong returns.
Exactly. So on those financials then, and if you're seeing a stronger recovery as well, as you said, again, would you stick to the preferred names, or is it a wider contribution that you foresee given the economic recovery that everyone's really counting on going forward from here? We've seen a whole host of stocks when it comes to the broader markets in the financial basket that have also been seeing exponential returns even this year itself.
Yeah, I think the first leg of rally would be led by the leaders, strong balance sheets, private sector banks, HDFC, ICICI, etc. And then as market gets more confidence on this recovery getting far more broad-based entrenched, we will see some of the leading PSU names, the likes of SBI, which are very attractive, participate in the rally. Select smaller private banks, which have niche regional franchises, can also participate. So I think it's really a function on how deep the conviction market gets in this recovery. And then obviously, like the way we see, the rally spreads from large caps to mid caps in the sector. And same thing is going to happen in financials.
Right. Rahul, the standout factor in all of the month gone by has been that FIIs have pumped in nearly about $1.8 billion in Indian equities this month alone. I mean, it's tough to fight this kind of dollar inflow. The market, the economy could be doing one thing, but it's the gush of liquidity which is really holding up the market. So tactically, would you say that stick with large FII-owned stocks? That's where you would make money and not lose?
Okay. What I'd like to comment here is, look, FIs were watching for 6-9 months, and when the economic data was poor, when the active cases were increasing rapidly, they stayed away, and there were better opportunities in markets like China, etc. Come October, again, India went through its period of underperformance. Particularly, the domestic cyclicals went through a period of huge underperformance compared to the rest of the region. And as one saw a number of active coronavirus cases kind of falling down, as one saw normalcy restore across large cities in India, one got a good feedback on Diwali or the festive season. The numbers were good from financials. That's where FI's money came in. So it's just not that money is coming in because it's India. People watch the numbers, people watch the traction on ground, and that's why that market's been rewarded with inflows. And if we see this recovery being built up, which is what our case is, that look, we are just in the phase one of the recovery, and if we see this recovery being built up, undoubtedly India is going to attract a lot more funds. The overweights which the foreigners are running in India is record low from a 10-year perspective. North Asian markets, China, Taiwan particularly, got a lot of inflows. So a bit of allocation may be shifted from those markets where risk reward is not that favorable to India.
Sure. Where, Rahul, would you be tempted to profit take, if at all?
No, of course, there are parts of markets where valuation are expensive. Again, consumer staples, valuations look expensive. There are parts of discretionary which are run ahead of fundamentals. I mean, autos one sees valuations being fairly priced to moderately on the expensive side. So those are the places one would take money or book profits and then move into, like the way I said, domestic cyclicals, which would be largely banks, industrials, etc.
Just to talk a little bit more about pharma, Rahul, you just highlighted that view. Do you believe that pharma is a story which is a long-haul play? We've just got a new IPO which is opening up today. It's the largest pharma IPO. But again, valuations is something which is debatable, and many believe that, it's a good story, but only to be bought whenever you see a dip coming in. That said, where is it that you still find opportunity within pharmaceuticals? Or would you say for now, the best is already behind us?
Bulk of the gains for the sectors are behind us. We've engaged in the sector in select companies where you've got these niche approvals which have come in US, which can meaningfully increase the size of their business, increase their profitability, etc. Outside that, one would just wait for a while and see this whole story of shift of manufacturing from China away to India. When you engage with large companies, they're not interested in this API manufacturing. It's not a profitable business. It's not a high ROC business. So they are reluctant to do that. I think markets run ahead of itself in terms of giving high multiples to the sector on this premise that you'll have large scale manufacturing shift from China to India. So again, there are pockets in the sectors which are expensive, and I won't be surprised 12 months from now, broadly, the sector may underperform the broad market, basically.
Rahul, every time we think that HDFC Bank is expensive, or Asian Paints is wildly expensive, or a Nestle is outpriced, those stocks, they continue to make money. That's been the 5-year story, and that's been the 10-year trend, and it could be the next 5 years journey as well. How do you deal with it? Because historical benchmark will always tell you that HDFC Bank is expensive, or Nestle is wildly priced, or Asian Paints is out of whack in terms of valuation. But if those companies are growing and those stocks are making money, how do you deal with this dilemma as a fund manager?
Okay. So I think what we saw in last decade, Nikunj, was unique. We had these huge deflationary pressures which came in last 3 or 4 years, and these deflationary pressures came because of what we saw, the ad hoc policy making regime which was there in US over last 4 years. I think that changes in the coming 4 years as we get more predictive policy regime, and with that coming through, inflation coming back, with governments world overspending, you have a revival of nominal GDP, and the rally gets broad-based. The economic recovery gets broad-based, the rally gets broad-based. So HDFC Bank, again, I would still say valuations are not that expensive. Let's say 20-22 times, 18 months forward is still reasonable. But the other names, the consumer staples, Asian Paints, Nestle, you said, are clearly expensive. So I think what happens is, as the growth gets broad-based, as the market gets broad-based, those names would be taken as a funding source from the market. So it's basically the whole thing of lower cost of capital, which took these valuations for some of the consumer staples from mean to 2 standard deviations above mean. Look, if you remember 3-4 years back, these names used to trade at 25-30 times. And now we are comfortable justifying them at 50 times. So I think that is going to reverse. With the US 10-year yields moving up, with again inflation coming back, we will see normalization of that. And which is where, if our view is correct on this economic recovery getting entrenched, you would look at the economic cyclicals, which are going to perform from here. So look, if one is willing to be a bit bold, I won't be surprised if some of the PSUs outperform these consumer staples. And it's a very bold call. But look, if government does the right thing, and rather than endlessly divesting stakes in these companies through these ETFs, they improve the capital allocation policy, which they've done with HPCL. I think the big trade for next 3 years would be PSUs outperforming some of the expensive consumer staples.
Rahul, what is going on the ESG front? Because that's where the money is moving. The data which we read, which is available in the public domain, is saying that ESG funds are getting inflows. If ESG trend is here to stay, and since you represent a global house which is going to be extremely sensitive towards ESG, What factors do you think will be at play because of this consideration when you're investing in India?
So if you look at ESG, obviously some of these high quality private companies rank much above the other peers, and which is where it's important that government improves on the capital allocation for the PSU owned companies. And if one sees that, obviously there is room for re-rating for these companies. What is a clear negative from ESG perspective is companies which are into manufacture of arms and ammunition. Tobacco is a clear negative. Coal mining companies which are in generation of power, which are largely thermal utilities, are negative. Outside that, I think one is okay investing in other businesses as long as you've got managements who act in interest of the minority shareholders. And I think what gets more relevant over the next 10, 20 years is what is the path towards being carbon neutral for the companies one is investing in. So all the companies which we've invested in, whether it's India or elsewhere, we're constantly engaging with them, kind of, and making them aware on the best practices in ESG.
Okay. Any outlier themes, Rahul? Anything that perhaps is just going to sneak up on us? We saw, for example, chemicals. We saw the rural theme really play out as well. So many of those tractor makers that managed to see really strong momentum even during a difficult time. What else do you feel could, particularly if we're watching out for the industrial rally and recovery going forward, let's say over the next 12 to 18 months, what are some of the ancillary themes that you think could play out?
Yeah. So I think plays there would be cements. Some of the industrial companies have not really participated in this rally. They moved up, but look, that's just more like an early cycle moves. As we get clarity of higher capital expenditure by companies, I think these names are going to move up. Outside what we've discussed here, again, the public sector companies would be attractive. Look, the broad view is there's no need to invest government in these companies. Government stretched has high fiscal deficit, so obviously these companies would bear the brunt of weaker revenue growth for government. But I think as the situation for government improves, these names can offer significant re-rating.
All right. And what to your mind, you mentioned the geopolitical risks. We've got the US elections, of course, behind us. That was one of the key events we were watching out for. What to your mind continue to be some of the risks, apart from, of course, the main one that still hangs like a cloud over all of us, and that's the rising case count. But, apart from the medical situation, anything else that you feel could be a concern, whether it be on the energy front, for example, or anything else that you're looking at?
So if we look at the risk basically from a market perspective, or the risk to this bullish economic recovery call, again, a lot of this is contingent on virus coming under control over the next 6-9 months through a launch of a successful vaccine. If that doesn't happen, obviously that derails the economic recovery. We've got plenty of geopolitical fault lines, whether it's the Indian border or whether it's the South China Sea. If you don't see sensibility prevail over there, obviously this whole thing can kind of unravel very quickly. So I think one has to be mindful, which is why it has to be a portfolio of steady growth companies, whether it's ID, healthcare, and then you bet on the cyclicals. One can't go whole hog the economic recovery story. But these would be the broad kind of risk from a recovery perspective, basically.
Rahul, great to have you on the show today and get in your views, and wish you and your entire family and team a very happy Diwali from all of us.
Thank you, and wish you and your team and your viewers a happy Diwali.